Hello, everyone. Today, what I'd like to do is go over some key points about the taxation of immigrants as they pertain to Canadian taxation laws. Um, but before I go any further, I'm not a CPA, I'm not a lawyer. This is for educational purposes or entertainment purposes. You should consult a professional for your particular situation. So, this is not meant to be taken as tax advice. So it's a general overview. I'm going to turn off my video capture and dive in. So the first thing you need to know about uh, the what is an immigrant. From a taxation point of view, it is an individual that establishes residential ties with Canada during a taxation year. For at the time that they do establish residential ties to Canada, uh, until the end of that taxation year. For that period, they're taxed on the worldwide income. And a an immigrant can also be a returning resident that formerly gave up those residential ties. It can be a Canadian citizen or a former permanent resident that at one point or another had seized residential ties with Canada and reestablished them. So it can be a completely newcomer to Canada or a previous citizen slash permanent resident of Canada that had ceased residential ties to Canada and subsequently returned to Canada and established residential ties. So this approach is diametrically different from the American approach, where uh, in the United States you are taxed by virtue of being a U.S. citizen on your worldwide income, and no matter where in the world you reside, you may be liable to do a 1040 income tax return. And the approach with Canada is they only tax residents of Canada on their worldwide income. And in the case of an immigrant, that worldwide income that you're taxed on is only during the portion where you reside in Canada. Now, what do we mean by residential ties to Canada? It is not, residential ties are not defined in the Income Tax Act of Canada. They're a question of fact. And there's primary ties to Canada and secondary ties to Canada. The primary ties to Canada are first and foremost having a home, a abode of habitual abode. A home in Canada could be a an apartment with a long-term lease, or your rightful principal residence, as we'd like to call it in Canada, the home which you own and ordinarily live in. Family are also primary, uh, and family dependents and social ties to Canada. All those are primary ties. The secondary ties are other types of property like vehicles, furniture, bank accounts, in social clubs, uh, a driver's license, and what have you. So, for example, if you're a member of a golf club, that too can be a secondary tie to Canada. Correct. Okay. Now, if you're ever uncertain about your residential ties to Canada, you should absolutely consult a CPA or a tax lawyer. There are forms that are used to by the CRA so you can get a ruling, a determination by the CRA whether you established residential ties called an NR 74, or in the case when you're leaving Canada, NR 73. And that gives you the peace of mind that the CRA, given the facts that you have to disclose, will assess your return according um, to that particular status, and you can do some tax planning ahead of the return. Deemed acquisition of capital property on immigrant. Now, what does that mean? Well, what that means is when you emigrate from Canada, that means you cease residential ties to Canada and have chosen to live abroad. There is a deemed disposition of your property. What few people know is that when an immigrant comes to Canada, there's a step up to the ACB of that property. it is deemed to have been acquired for the case of an immigrant. Capital property is deemed, and that can include a chalet, it can include stocks and bonds. Those properties are have been assumed to have been acquired at the fair market value on the date of entry. So in that case, knowing this fact, there might be some research you need to do or some homework. The homework being, if you have real property, you should get an evaluation of that property from a chartered real estate agent or somebody that can uh, guarantee on paper the fair market value of that property. So if it's ever called in question, you won't have any issues. For stocks and bonds, that's pretty evident because you can find, usually you can find the that fair market value on historical charts. Google offers that information as well. So interesting fact to know there. All right. Now, non-refundable tax credits, and there are proration rules pursuant to subsection 118-.91 of the Income Tax Act of Canada. For all part-year residents, according to the Income Tax Act of Canada, let's say you have a base amount of a non-refundable credit of 15,705, as the example shows. However, you only resided in Canada 240 days out of 366. Then that credit, non-refundable tax credit, which essentially means the amount of money you can earn on the first tax bracket before you pay a dime of tax or a penny of tax, it would be prorated to reflect the number of days in Canada down to 10,298 in my example. The 90% rule is applicable only for your non-residency period for non-residents. And basically, what that means is for the non-residency period, if you are your worldwide income or your Canadian source income over your worldwide income, if that ratio is 90% or more, you're entitled to your full non-refundable tax credits. Now, how does that work? If you're a part-year resident, you're obviously a non-resident for part of the year, and for that amount of time, you may be entitled to your full non-refundable tax credits. However, for your non-residency period, it's always prorated. The sum of the two would equal 100%. All right. Now, pre-arrival income considerations. What you need to know is prior to establishing residential ties to Canada, there's two types of income that you can probably generate. And it's important to note that income subject to Part 13 tax, in that case, if it's not absolved from any taxation due to a tax treaty, you'll probably pay a lump sum of tax to Canada if it is um, subject to Part 13 tax. So for example, interest would be a passive income that is subject to Part 13 tax unless it is treated otherwise by a tax treaty between Canada and the foreign country. In that case, the issuer of that Canadian source interest will issue you an NR4 slip. It will have a certain amount of tax deducted at source. It could be 25, it can be 10, it can be 5, depending on what the treaty between the foreign country and Canada stipulates. It can also very well be 0. Now, that income reported on an NR4 has no business on a T1 income tax return. Your non-resident tax that you paid as a non-resident, okay, it does represent your final tax liability. If it was deducted or paid inadvertently, then you have to express the reason in writing to the CRA as to why it was inadvertently paid, and they will issue a refund to you accordingly. If that income actually was earned while you were a resident of Canada, then of course that tax should be returned to you from the CRA, whatever lump sum it should be, and you would otherwise pay tax on graduated rates on that amount. There's also an instance where if you earn Part 1 tax, for example, can be employment income. And if you earned it during the non residency period for services rendered abroad, meaning not in Canada, it could very well be excluded from the taxation in Canada. The other types of returns you could possibly do as a non resident of Canada is a Section 216 return or a Section 217 return. So, foreign social security and tax and treaty relief. That's something that is grossly overlooked by a lot of tax professionals. And what that stipulates is that if you are coming from a state where there is a social security agreement between Canada, you also have to look at um, the tax treaty. There may be a provision in the tax treaty that says if you continue paying social security to a foreign country while you're established residential ties to Canada, those contributions may very well be deductible on the Canadian return for at least 5 years, 60 months while you're residing in Canada. So there's also some research to be done there. Um, and it is an important um, item not to omit on your part year return and your subsequent returns in this case. And our last takeaways, our last slides are our major takeaways, which are 5 in number. Can count them on one hand. Tax residency is a fact based. The date residential ties are established may differ from the arrival date. Why? You could have came to Canada early to stake out a house. It was a temporary visit. That doesn't count. The moment you come to Canada and you have a habitual abode, a home in Canada, and you took the key, opened the door, that could very well be your um, your date of entry. Again, it's very important to establish that with fact, document it in writing, get a professional consultation so in case it's challenged by the CRA, you have backup. Number two, capital property ACB is stepped up to the fair market value of the date of immigration. No Canadian tax on pre-arrival appreciation. Um, there may be tax in the foreign country, but not in Canada. There will be, what you have to keep ahead in the back of your mind is that there will be a deemed disposition down the road if you so decide to return to a foreign country. Therefore, it is very important that you establish and document the fair market value of your capital property and the date of your arrival to Canada. Takeaway number three, non-refundable tax credits are prorated by default. 100% may be claimed if Canadian source income greater than 90% of your worldwide income during the non-residency period. Um, a little uh, more color to that point, the proration may end up being a lot dire than thought. You could think because the CRA and Revenue Quebec have come up with more um, methods of prorating that are more stringent in terms of allowing you your non-refundable tax credits to the point where your your credits could be the non-refundable tax credits that your spouse can transfer to you can be double prorated according to the rules. So you need to be careful about that. NR4 Part 13 income is generally excluded from the T1 return but may be relevant for the 90% test for your non-residency period, and foreign employment income for services abroad may be exempt, but only for the period of time where you were a non-resident of Canada. Foreign and Social Security contributions may be deductible if a qualifying Social Security agreement and tax treaty is in force between Canada and the foreign country. Just two examples is France and Germany, to the best of my knowledge. Um, and that's basically it. a nice 15-minute presentation that gives you the taxation of immigrants in Canada in a nutshell. Um, Again, I have to emphasize that I'm not a tax lawyer or a CPA. And if you do have any questions, do consult a professional. Do not hesitate to do so. Um, an, in, an income tax return that represents the time or the year that you have established residential ties to Canada has to be taken seriously. There's homework to be done, and if you do all your homework, check your check boxes, cross your T's, dot your I's, you'll do well. And with that said, I bid you farewell and do look forward to um, more videos down the road. Like and subscribe and tell some people, some folks or friends about this channel. Take care for now.